I'm Sebastian St. James. It's almost the end of the financial year. It's a panic! It's a panic! So what do you need to do before it's too late? Too late is midnight on the 30th of June, when you turn into a pumpkin. Should you sell off your shares, or should you buy them? I mean, can I reduce my taxes that way? I've heard of tax harvesting. Can I tax loss harvest? Can I tax gain harvest? Ugh, if only there was a video that would explain all this to me. Well, today is your lucky day. This is Mike Prestonogo, and he's one of my channel members. Mike earns $180,000 a year. Way to go, Mike. He wants to reduce his income bill by buying shares. Okay. Is that such a thing? Buying shares to reduce your income tax. Isn't that kind of like negative gearing? Isn't the expense of the shares I can offset against my income? No, that is not a thing. Any expenses that you incur within buying shares are actually locked within the capital gain or loss structure and have no effect on your income tax bill at all. This is Fiona, and she's one of my channel members. Fiona is a stay-at-home mum. She earns nothing, and she owns BHP shares. Fiona's tax rate, she's zero. There we go, on the tax-free threshold. She can earn up to $18,200. That's 18.2K that you can earn every single year without paying a cent to the government. So use that tax-free threshold wherever possible. Right now, she owns 900 shares of BHP, which she bought for $24.60. Look, the price has gone up to $44.60. So that's a $20 rise. Fiona is carrying a paper profit. Should she crystallize that by selling her shares? But there's a problem. Depending on how long you've held your shares for does depend on how much you're taxed. Yes, I know. Question. Have you held your assets for 12 months or greater? If so, then you get the 50% capital gains discount. Aha! Meaning you pay half the tax. And I like paying half the tax. That means the other half of the tax I get to keep. Now, should you automatically hold your shares for 12 months because you want to lock in that capital gains discount? Well, it depends. Sometimes the answer is yes. Sometimes the answer is no. Let's see why. I own stock ABC. I'm bored. I might sell it and buy DEF. Well, you may want to wait for the 12 months to get your 50% capital gains discount. You're welcome to flip shares whenever you want to, but if it's on a whim, you may as well get your discount. ABC is a dud. Aha, I knew it. It no longer meets my investment hypothesis. In that case, you may want to sell and invest in something more worthy. It's happened to everybody. You buy into what you think is going to be an amazing company, suddenly the CEO is fired, and they realize the company's been embezzling the entire time. And so what happens then? The share price dives. Should you hold on to your company for 12 months because, I need to get my 50% capital discounts? No, your company's a dud. Get rid of it as soon as possible. It's nearly tax time. I want to crystallize tax gains or losses. Is that a good time to sell? Well, you may want to sell to crystallize that loss or gain. Let's check in with Fiona. She purchased her 900 shares on the 15th of July 2022. Aha, that is this tax year. Which means there's no discount for Fiona. She hasn't held them for 12 months. But we got to remember about that $18,000 that's going begging. So she decides she will sell the shares, which she does so on the 24th of June. Shares sold. Now, how do we work out our taxes? In a previous video, one of my viewers said, if you could walk us Muppets through the nightmare that is taxation and the selling of shares, I would truly be grateful. Okay, Muppets, listen up. Capital gains equals sales proceeds minus costs. Let's work out how much Fiona has to pay. Sales proceeds is simply the amount she gets back from selling the shares. 900 shares sold at $44.60 equals $40,140. But hang on, that sale doesn't come for free. Fiona has to pay some brokerage, doesn't she? Yes, she does, but we don't account for that yet. Here is cost base. Right, 900 shares which she bought, that's cost number one, at $24.60 equals $22,140. Now, the brokerage to buy is $15. That covers all the buy costs. But then you add in the brokerage to sell, which was $30, giving you a grand total cost base of $22,185. Now, we know that capital gains equals sales proceeds minus costs, which is $40,000 minus $22,000 equals $17,955. But here's a secret, there's even an easier way of calculating your capital gains. When you buy or sell shares, you go to your broker and it tells you exactly how much money they're going to take or give to you. Your brokerage statement will say something like, buy 900 BHP shares, the total is 22,155. That figure represents the cost for you to buy, the total cost. That means the price of the shares plus the brokerage. And we sell the shares and we get this line item. 900 shares, the total is 40,110. That's the amount of money they're giving back to you, the proceeds of the sale minus the brokerage cost. Using those two figures alone, you can calculate what is your capital gains. Well, my sale proceeds is 40,110 minus my buy costs, which are 22,155, equals 17,955. That number looks oddly familiar. Because in fact it is. It's the same value we came up with before. I know, it's like voodoo magic. Oh, I just got a thanks from Gaurav. Thanks. Still keen on that comparison between lump sum investing versus dollar cost averaging over time. Thank you very much, Gaurav. Gaurav's thanks plus his channel membership pushes that question further up the queue. Way to go, Gaurav. So if, like Gaurav, you want to have your questions shoot up the queue, and obviously you do, hit the join or thanks button below this video. Back to Fiona. What was the tax-free threshold again? 18.2k. Got it. Her capital gains, 17,955. Aha, we're in luck. That means Fiona has to pay no tax at all. But she still has to do a tax return. I know, but let me do that for her. Question number 18. Did you have a capital gains tax event during this year? Yes, I did. Have I applied any exemptions? No, I haven't. Net capital gains, 1,700,955. I've had no other business, so the total is the same. Tax owed, $0. Hooray! Fiona sold her BHP shares because, well, she wanted to use a tax-free threshold, but she actually likes BHP. She'd like to buy those shares back again. So what happens then? Now that the tax is accounted for, she buys at the new price. Oh, that becomes the new tax base. Got you. Isn't that kind of somehow illegal? Well, you have a tax-free threshold. You are entitled to use it. Fiona has bought back the shares, which has reset a tax basis, and then if she sells it at 64.60, if she's still under the tax-free threshold, she pays once again no tax. Hang on, isn't that a wash sale, and therefore that's illegal? Well, let's come back to that. This is Mr. Steve OC, and here's one of my channel members. Steve is married to Fiona. Oh, you didn't see that coming. He earns $300,000 a year. Way to go, Steve. High-income earner Steve is married to no-income earner Fiona, which brings us to the next point. Investing in the name of the spouse in the lowest tax bracket helps to reduce taxes. This is Haimai, and he's one of my channel members. Hoi is an importer. And what does Hoi import? Oh, he imports wombles. Well, that wasn't even on my list. He earns $350k a year. He bought CBA at $58.51. It's now $98.51. And if you'd like to appear in the stories of my videos, just become one of my channel members. Should Hoi, the high-income importer, sell his shares for tax purposes? Let's take a look. At the moment, oh, he's on the top tax bracket, 45%. Unlike Fiona, if Hoi sells now, he'll be paying top dollar. But Hoi has a secret plan. He plans to retire at the age of 50. Good for you, Hoi. So what happens then? What he earns will drop 200k a year, but importantly, his tax bracket will go from 45% down to 32.5%. Aha, I see what's happening here. If Hoi still wants to sell his CBA shares now, once he's retired, would be a much better time. That leaves us with tax loss harvesting. This is Robin, and she's one of my channel members. She owns Zip. Oh, I'm sorry to hear about that, Robin. Look at that. What a disaster. Robin has paper losses of 50k. But she's also sold off Coles shares and has a capital gains of 50k. Aha. 50k gains that she definitely has to pay tax on unless she can offset that with a 50k loss. Are you thinking what I'm thinking? That you should have a sleepover at my place and we'll discuss stocks? No, I wasn't thinking about that at all. If she took that paper loss and crystallizes it, the 50k gains and capital gains minus the 50k loss does in fact equal nothing. And that is called tax loss harvesting. Is that legal? You can deduct allowable capital losses from your capital gains to reduce your capital gains tax. Exactly what we did. Capital losses must be used at the first opportunity. So far so good. No tax for Robin. Completely legal. But Robin believes in the future of Zip. Sure, she sold her Zip shares so she could crystallize that loss, but she still believes in the future of the company and she wants to buy those shares back. Well, hang on there. That could be a wash sale. The ATO is cleaning up the dirty laundry. The ATO is warning taxpayers not to engage in asset wash sales to artificially increase their losses and reduce gains or expected gains. Wash sales are a form of tax avoidance that the ATO is focused on this tax time. Wash sales typically involve the disposal of assets just before the end of the financial year, where after a short period, the taxpayer reacquires the same or substantially similar assets. This is a wash sale and is done to create a loss to offset a capital gains already derived or expected to be derived. Oh, okay, so you can't just go selling shares for tax purposes and then buying them back. But what happens if I sort of trade shares anyway and I buy and sell and I'm not doing it for tax purposes, but, I might accidentally trigger something? A wash sale is different from normal buying and selling of assets because it is undertaken for the artificial purpose of generating a tax benefit for the current financial year. The taxpayer disposes of and reacquires the assets for the deliberate purpose of realising a capital gains loss and obtaining an unfair tax benefit. Unfair according to the ATO. Let's see if this applies to Robin. So she sells Zip on the 22nd of June and then she buys it back, on the 2nd of July. Yes, that does seem a bit suspicious. That could definitely be seen as a wash sale. So what should Robin do if she wants to sell Zip to crystallise her losses? Just don't buy back the same shares, Robin. Instead, she buys Rio on the 2nd of July. Is that acceptable? That is fine because you're selling a buy now, pay later company and you're buying a minor, totally unrelated. No wash sale has occurred. But what about the stay-at-home mum, Fiona, and the early example we saw of her buying and selling shares? Is that not a wash sale? Isn't she going straight to jail? Oh, here it is. Clearly, selling off at $44.60 and buying back the same day. It's the same price. Well, it does seem suspicious to me, but let's look at what the wording actually says. Wash sale is done to create a loss, to offset against a gain. But when Fiona sold, she sold at a profit, so no loss took place, therefore no wash sale took place. Phew! Fiona is in the clear. The question is, in this tax year, if you've already got capital gains locked in and you have a potential capital loss, should you sell that to offset the gain? As in the case of Robin, capital gains definitely there, capital loss, well, it's up to you. Well, if you don't offset that gain, you're definitely paying tax on that. There's no two ways about that. Now, if you can offset that against a loss, that is entirely legal. But make sure that you're happy to sell that share at a loss and that fits in with your investment hypothesis, and make sure that you don't buy it back straight away because that would be a wash sale. So far we've discussed individual shares. What happens if you own index funds? Well, it can be slightly more complicated. This is Robert Leonard and he's one of my channel members. Robert believes buying individual stocks is too risky and you should never do it. Therefore, he only buys index funds. He's just sold off IVV at a profit of 100k. Well done, Robert. IVV is the S&P 500. He owns an ASX 200 fund and he has a paper loss of 100k. Oh, those two figures balance out. Power Ranger activate. Total tax bill, 0. So well done. No tax bill and, of course, his index fund, so he wants to buy the A200 back. Oh, but that is a wash sale. You can't do that, Robert. Because you're dealing with index funds here, well, there's fewer choices to buy, isn't it? Particularly if you have, say, one that is your favourite index fund. If you sell it and you're going to buy it back, that's definitely a wash sale. But Robert is smart. He has an idea. He's going to sell A200, which is an ASX 200 fund, and then he's going to buy back STW, which is also an ASX 200 fund. Oh, clever idea. Is that a wash sale, though? The ATO could argue that it is, because you've sold off one ASX 200 fund only to buy back another one, and they could argue that's a wash sale. Well, what do I do then? Well, if you sold, say, an Australian index fund and bought for a little while a US index fund, that's definitely not a wash sale then. Importantly, June 30 is only next Friday. I know, it's a panic, so have a look at your assets, decide if there's anything that you need to do between now and then. In the meantime, if you have an emergency, how much cash should you hold? I don't know. What type of an emergency is it? Click here to find out. Or if you've seen that, click here.